All right, so today I'm going to be talking about dividend investing versus growth investing. Last video I talked about why you should invest, and now I'm diving into the two different major types of investing regarding the stock market. And I'm going to give some real world examples using Apple, JEPI, JEPQ, even S&P 500, and then a few others. And then at the end, I'm going to give you guys some strategies, my advice, and the best way to use this information. All right, so to start it off, what exactly is dividend investing? It's basically a strategy built around earning consistent income. So when you invest in dividend paying stocks or ETFs, you're essentially buying into companies that share a portion of their profits with you. This payout is called a dividend, and it's usually sent out quarterly or monthly. Now, these aren't flashy or high growth companies, but they're well established businesses with strong cash flow. A few examples of these would include Coca-Cola, Procter & Gamble, or even utilities and banks. They're not going to double in value overnight, but they're stable, reliable, and consistent with their payments. One of the most popular dividend ETFs right now is actually JEPI. If you don't know what JEPI is, it's the JP Morgan Equity Premium Income ETF. So JEPI holds large cap US stocks, but it also uses option strategies to generate monthly income, which has been typically yielding between 7 and 9% per year. That's a lot higher than the S&P 500's average dividend yield, which sits around 1.5% right now. So what makes dividend investing powerful isn't just the income, but the ability to reinvest the dividends. So over time, reinvesting can lead to a significant compound growth. And this is especially true if you're still in the wealth building phase. So one of the nice things about dividend investing is when there's economic downturns, when the market goes down, most recently with Trump's decision to put big tariffs on the rest of the globe, you're still going to receive money from dividends. And this effect is really going to help stabilize your portfolio, because over the course of the year, if the markets were bad and your other stocks or investments didn't perform well, at least your dividend investments were either able to directly give you cash or you put that back in, which leads to further growth. So now I'm going to talk about what is growth investing. So instead of focusing on income, growth investors are looking for stock price appreciation. And I'm sure you've heard this many times, but this is basically buy low, sell high. So growth companies usually don't pay dividends. Instead, they reinvest their profits back into the business. This helps develop new products, expand into new markets, or even acquire other companies. The basic idea is that by reinvesting, the company can grow faster, and as a result, its stock price is going to rise. A great example of this is Apple. So Apple does pay a small dividend, but it's widely considered a growth stock, and that's because most of its return has come from the rise in its stock price, not the dividends they've dished out. Over the past 10 years, Apple's price has skyrocketed for a number of reasons, which include innovation, brand strength, and even expansion into services like iCloud and Apple Pay. Another example is JEPQ, which is a growth-oriented fund from JP Morgan. It's kind of similar to JEPI, although it focuses on NASDAQ stocks, which include tech-heavy names like Nvidia, Amazon, and Meta. These companies are more volatile, and that's particularly because they are tech companies, but they also offer some of the biggest upside for potential in the long run. Growth investing does come with more volatility though. Stock prices can swing wildly, but if you have time on your side and you can stomach the ride, the long-term rewards can be much larger than those from dividend strategies alone. All right, so I'm going to pop up a little chart right here that shows the key differences between dividend investing and growth investing. I feel like personally seeing a chart like this just helps me better understand the information, and it summarizes it in a lot cleaner of a way. So the objective of dividend investing is regular income, and the objective of growth investing is more capital gain focused. Dividend investing has a lot lower volatility, while growth investing faces higher volatility. Dividend investing obviously is going to provide dividends, while growth investing typically doesn't. I know earlier I said Apple does give dividends, but they're relatively small. All right, so for tax considerations, some of you might be a little bit confused by this, so I'll break it down a little bit more. When you invest in dividend-paying stocks or ETFs, every time you receive a dividend, it's considered taxable income, even if you reinvest some of it instead of spending it. So these dividends are typically taxed in the year that you receive them. And there's two types. So there's qualified dividends, which face a lower tax rate, and they're taxed at the long-term capital gain rates, which are either 0, 15, or 20% depending on your income. And most dividends from US companies or ETFs like JEPI qualify. And then there's ordinary, which are non-qualified dividends. And these are taxed at your regular income tax rate, which can be a lot higher depending on how much you make. So an example of this, if JEPI pays you $1,000 in dividends this year, you'll owe taxes on it this year, even if you reinvest it. All right, now though, with growth investing, taxes are deferred until you sell. So since your growth stocks typically don't receive dividends, instead your wealth is going to grow as the stock price rises. So you're only going to pay taxes when you sell the stock, and this would be realizing your capital gains. So with growth stocks, you're receiving a tax deferral basically, which is allowing your investment to grow tax-free until the moment of sale. If you hold for more than a year, you'll pay the longer-term capital gains tax rate. So just to give an example for this situation, I believe Apple is sitting around 206 today. I'll pop it up on the screen. But let's say you bought Apple today at 206 and then it were to rise to 300. You're not going to pay any of that tax until you sell. And if you never sell, you would obviously not owe capital gains tax. And this is sometimes called buy and hold tax efficiency. Now, the majority of people at some point are going to sell, but the longer you can hold off selling, the longer you delay paying taxes, which allows your full investment to compound for a longer amount of time. I haven't covered the S&P 500 yet, but it's a blend of both dividend and growth investing. Companies like Procter & Gamble pay strong dividends, while others like Amazon are purely for growth. The S&P 500 typically yields about 1.5%, which makes it a pretty moderate choice for dividends, but it's balanced between income and growth, which makes it more of a balanced fund or even ETF depending on the way that you buy it. So for the last bit of this video, I'm just going to talk about what strategy you should use. The truth is most people don't pick strictly growth investing or dividend investing. They blend it together and use both, and this will help diversify your portfolio but also give it stability like I talked about with dividends in the beginning of the video. You can think of dividend stocks as the foundation of your portfolio because they provide steady income, help cushion downturns, and offer peace of mind. On the other hand, you can think of your growth stocks as your rocket fuel. Sure, growth stocks might be a little bit more volatile, but they give your portfolio the chance to grow at a faster pace over time. And this is especially great if you're young because you have a long time to invest and you can handle some short-term swings. To really further simplify this, I'm going to be talking about two different age groups. So, if you're nearing retirement or just like seeing cash flow hit your account every month, you might want to go more dividend heavy. Funds like JEPI or even other blue chip funds or stocks can help you generate reliable income to help you cover your living expenses, or you can just choose to reinvest that money. Now, for the second group, if you're a little bit younger, let's say in your 20s or 30s, and you're focused on building long-term wealth, you should probably lean towards more growth names like Apple, Amazon, or even growth-focused ETFs like JEPQ that ultimately aim for higher capital appreciation. But like I said earlier, the best portfolios are often blended, but using your age and your financial goals, you can decide whether you want to lean heavier into growth or dividend investing. Like I say every time though, this is not financial advice. This is just ideas to put out for you guys. You should really research these topics if you're interested and come up with your own plan, your own strategies. And hopefully you learn something. The goal of this is ultimately exposure. So go talk to your friends, your family, think about this, do research, and I hope you all have a great day.